Almost had her. Besides the fact that
They said recorded.
I have these
We recorded.
So that's right. Nice to meet you. So anyway, that was me. So then the next one was, I should all have the same budget. Once you get started with the other four.
Did you meet these guys?
I haven't.
Nancy Michelle Riley, former County Commissioner.
Okay, great.
Yeah, as a taxer.
And
This was my idea.
Alan, do you know these guys? Hi, Alan. Tamiko.
I was looking at it right there.
You guys are covered on one?
Yeah, it's true.
Tamiko? By Jeff Mitchell.
I knew he was going to be
Nancy's going to do the introduction and moderate the
Great. All right.
they just listen to me.
But it is,
You get your eyes in there.
So you can't
No, but I mean, so one of the issues of you're in the low government.
Yeah, a month ago.
Is that the time?
Yeah.
And I understand, you know,
Yeah, thank you.
where we,
Great.
I mean, we go to the governor's office and say, oh,
Okay. Okay.
we don't want to do that.
Plus we're also
You know, especially when it comes to that, the June. You know, by having.
I'm not.
You may that next week. You know, we booked it. And we used to get like the 20, and then they kept it up to 24, 27. Now we're getting the first. So I know it's one of those total authorization.
I'm myself one of those things. So many goes to when you get through
So we start the way.
Sometimes it makes you so
But the clicker on the podium.
Oh, okay.
we send it to
Anyway.
How are you? Thanks for being here last night. I know you guys were like, oh yeah.
So he was getting coffee.
Did you know I was
For those on video on the phone, please mute your phone as well as your microphone on your computer. For all those attending remotely, please mute your microphone.
There we go, there's a good one. I hate being that guy.
Especially when you don't know it.
The other one's worse, someone puts you on hold, and they have to use it first. Not hold, mute.
We used to have a lot of positions open in the North County.
Good morning. This is a workshop on where's the money, understanding county revenues. Well, I want to welcome everybody that's here in the room and attending remotely. And just so you know, my name is Nancy Boland. And I was an Esmeralda County Commissioner for 12 years and now happily retired, and also an ex-NACO president. And this was my idea. So well, I'd like to ask you now that if you are attending remotely and there's more than one person at your end, would you please state your county and the people that are attending so that Amanda has a record?
Good morning, Nancy. This is Lorinda Wickman in Nye County. We're attending from Tonopah, and we have another gentleman here with us, and he'll introduce himself.
Good morning. This is Commissioner Ralph Keyes from Esmeralda County.
Good morning, Nancy. This is Dan Schoenhofen, attending for Nye County and Pahrump, and I have John Koenig, our PIO, Arnold Knightley, and Elizabeth Enriquez. We're all here and anxious to see this. Thank you.
Is there anybody else?
Good morning, Ken. Good morning, Ken Gray, Lyon County.
Ken, is there somebody else there with you?
No, ma'am, just me.
Okay. All right. Anybody else where there's more than one person at your location? Okay, I'm going to take that as a no. Okay, I want to remind you all that this is being recorded, so it's very important that we get who you are and identify yourself when you're asking questions or putting input. And then this workshop is sponsored by the NACO Committee of the Emeritus. The Committee of the Emeritus is a group of former county commissioners who advise and help the NACO board. The committee was formed with the goal of preserving the institutional knowledge and expertise of commissioners who, due to term limits or other factors, are no longer in office, but who possess invaluable knowledge about county government in Nevada. And now I have a few housekeeping items. As you have previously been told, please mute your phones or your computers if you're attending remotely. We're going to take questions at the end of the presentations, and we'll have about 20 to 30 minutes put aside for this, so please hold the majority of your questions to the end of the workshop. The bathroom, for those of you who are not familiar with this building, is located right in that corner through that door. Both the men's and women's are there. And if you want to receive credit for the Certified Public Official Program, you can do this for this workshop, so please contact either Amanda or fill out the form that we have here in the room if you're right here. So the purpose and goal of this workshop is to provide you with a working knowledge of the major tax revenues your county receives, where they come from and how they're distributed, to empower you as a decision maker. Now, this became quite invaluable to me when I was in office, and some examples of how it came in handy for me as a commissioner were when we had discussions with the Nevada Economic Development Authority on tax abatements and also testimony related to that, because they changed a lot since we were having that fight. But at the time, I think it was 2010, they put abatements in on sales tax, which later got revoked because they figured out that maybe we were right. So that came in handy, and over again when I was giving county presentations, I would relate to our financial figures, because the people in the legislature really can relate to that, no matter if they're from the north, the south, or the rural. The other part that came in handy is when I got to know a lot of the detail, I realized that we get property tax on commercial air overflights in our county. So when you're looking at something like the Nellis airspace expansion, that might affect your revenues in your county because of rerouting of commercial aircraft. So it's very important that you understand everything that goes into where your tax dollars come from, because believe me, it can be quite enlightening. Okay, our speakers this morning. First, we're going to have Alan Culp. He's a certified public accountant. He served as the Churchill County Comptroller and Chief Financial Officer for over 25 years. In 2018, Alan accepted the position of Chief Financial Officer for PoolPack in Carson City. He's also been serving on the Committee on Local Government Finance with the NACO appointment for over 15 years. Because of his vast experience in local government finance, he presents various classes for extended studies at Nevada. He's an honor graduate from Montana State University. Alan and his wife, Kieran, have 3 children and are proud to call Fallon home. Alan will give a general overview of county revenues for us this morning. Next, we have Kathy Lewis. She's the clerk treasurer of Douglas County. She's been a clerk treasurer since 2015. And before that, she was Douglas County's budget officer and worked at the county for 13 years. Kathy's a CPA and has a master's degree from Weber University in Utah. Kathy's going to explain property taxes. The rest of our speakers are joining us from the state of Nevada's Department of Taxation. Tamutko Masser is a deputy director over the Administrative Services Division of Taxation. Tamutko has worked for the department for 18 years in a series of different roles, most recently serving as deputy director for 5 years. She oversees distribution and statistics, budget, and the department's accounting and processing sections. Kevin Williams is a management analyst with the Department of Taxation, working in distributions and statistics. He has worked with the department since 2013, starting as an accounting assistant and working in processing. He then moved to the distributions and statistics team, where he worked on balancing and providing support to management analyst position. So Tamutko and Kevin will explain to us how CTAX is distributed. And now we have Jeff Mitchell. He's worked for the department for a little over 5 years, before which he worked for a local government in Utah. He started at the department as the coordinator of assessment standards, after which he moved to the supervisor of central assessment, a position which he held for approximately 3 years. He has recently transitioned to the position of deputy director of local government services and is working hard to maintain the level of service and commitment that has been provided in the past. Kelly Langley, CTP. Kelly has worked at the Department of Taxation in total approximately 8 years, with 25 prior years of experience with NV Energy. She has served as a supervisor of centrally assessed property for 2.5 years and is currently serving as the supervisor of local government finance, a position which she has held for 3.5 years. Kelly has an extensive background in finance, both in the public and private sector, and is a valuable asset and resource that the Department of Taxation relies upon heavily. Jeff and Kelly will teach us how net proceeds of mineral works. At the end of the presentation, we should have ample time for questions. So I hope you have questions. If you need it, you should write them down as you hear the presentation. So up next is Alan.
Thank you, Nancy, and thank you, NACO, and Dagny for this opportunity. You know, I think it's so important that we get together as a group and we share knowledge. You know, working together, obviously, with our peers and developing knowledge, we become better at what we're doing. And I appreciate the fact that local elected officials are willing to participate. Today, what I'm going to talk about is where's the money and the overview of where those resources are. So, show me the money. Where is it? You know, look at that pie allocation. Just like we have an asset allocation within our own, let's say our investment portfolio, as a local government, we need to understand the revenue allocation or the distribution of revenue. Where do we get our main sources of revenue? What are those revenues that are reoccurring? What are those one-time type revenues, and evaluate those? So what I'd like to do is just show you a couple of local governments to give you an example of the allocation. We'll start with my entity that I've worked for over 25 years, Churchill County. So if you look at the governmental funds there, you can see the property tax, that portion, we collected $7.8 million. Licenses and permits, $530,000. Intergovernmental revenues, $9.8 million. The consolidated tax or sales tax, the six-pack of different governmental revenues, $5.3 million. Charges for services, $1.1 million. Fines and forfeitures through the courts, $458,000, and other miscellaneous revenues and financing sources and uses, of 1.7. That's what it looks like for a mid-sized rural local government. Let's look at our friends in the allocation of Clark County. And one of the things to look at here is that if you were to look at this pie and you go to the optometrist and they go, what looks better, this or this? So that's Churchill. Just focus on, let's say, the blue pie and the magenta one. You can see that both local governments have, some of the big revenues remain the same. Property tax, consolidated tax, and intergovernmental revenues are what we call the big three. Okay, so as an elected official, an appointed official, someone who deals with government budgets within your local government, I think it's really important for you to understand where your revenues come from. If we look at a city, the city's pie actually is just a little bit different on how they do that. And clearly, if we were to show a school district pie, their allocation of revenue would be a little bit different as well. So what I have up here on the screen right now is the statement of activities from the Churchill County audited financial reports of the governmental activities. And this shows the very broad base of all our different revenue resources within a local government. So let's go ahead and let's talk about what's commonly referred to as the big three. Intergovernmental revenues. Those are pass-through revenues that the counties get from the state and from the federal government. Examples of that might be payment in lieu of taxes from the federal government, grants that we receive from the state and or the federal government, gas tax revenues, state gaming licenses, the consolidated tax, the private car tax. Okay, so intergovernmental revenues is a big portion of that. The next one is property tax, probably the most talked about revenue resource of a local government. And finally, we have consolidated tax of the big three. And that's 6 individual revenue resources. I'm going to go into it in more detail, but 2 of those components are the sales tax, the basic city county relief tax, and the supplemental city county relief tax. Then you got real property transfer when we buy and sell real estate within your community, the government services tax when you go to DMV and you license your car, then the sin tax, the liquor and cigarette tax make up those 6 revenues get combined into the consolidated tax. Most local governments, you take these 3 sources of revenue and it's going to make up probably 60 to 70% of your total revenues. So what I want to do is I want to talk about some of those other revenues. In our financial statements, we list out revenues within these object levels: property tax, licenses and permits, intergovernmental revenues, and within that you'll see the consolidated tax, you'll see gas taxes. We have what we call charges for services, those charges that we, for the users of the services. Fines and forfeitures, voluntary taxes for speeding a little too fast, those are collected and classified under fines and forfeitures through the courts. Miscellaneous revenues and other financing sources and uses. So let's jump right into licenses and permits. What are some of those revenue streams that we in our local governments have? Business licenses. Okay, that's a great example. Primarily, local governments have almost 2 different methods of how they want to do business licenses. Some do a fixed rate per month, per quarter, per year. Others may do a floating rate based on total level of sales. Okay, that's a decision that a local government needs to make at their level to determine how they want to collect that and what type of revenue resource is that going to be. Is it going to be a revenue resource just to cover the cost of providing the business license office and the oversight, or is it going to be used as a revenue enhancement, a way to generate additional revenues for your local government? Another example of licenses and permits is local gaming license, fees associated with local gaming licenses, the marriage license, liquor license. Next one that can be rather large is building permits, permitting fees, special use permits, those type of fees that you collect within your own local government based on the policies and the ordinances adopted by your jurisdiction. Franchise fees and business licenses. The statutes dictate the allowable amount and how you can ratchet those upwards to up to 5% and get those as steady revenue resources. And those are very important because that's just like investments. You want a good allocation in local government. We want a good allocation of stable revenue resources to help fund the necessary services of local governments. So let's talk about some intergovernmental revenues. One that I want to talk about that is always important because as elected officials and appointed officials, a lot of times people say, hey, pave my road. And gas tax is a huge component of intergovernmental revenues. So at the gas tax level, there's 18.4 cents. That is an excise tax at the federal level. The state has 23 cents. Local government has the ability to have 10 cents. So let's walk through each one of these rather quickly. So at the federal level, obviously it's enacted by Congress, signed into law by the president. It's 18.4 cents. This rate has not changed for a long period of time. The state taxes, again, it's an excise tax, so it's based on the gallons, number of gallons sold, not the price at the pump. Okay, those state taxes are enacted by the state legislature. The local taxes, obviously, are enacted by the Board of County Commissioners. So we look at state gas tax. NRS 365 chapter provides the guidance there. 17.65 cents goes into the state highway fund. Of that 17.65 cents, 5.35 gets reapportioned back to the counties. So that reapportionment to the counties, 1.75, is distributed back to the county based on point of origin. So what point of origin is where the gas is sold, that local entity gets that. So if gas is sold in Lyon County, on a point of origin distribution, the revenue goes back to Lyon County. If the gas is sold in Washoe County, clearly it goes to Washoe County. We have 3.6 cents that is distributed by a state formula. Okay, and those formulas, different taxes have different formulas, and some of those provide a situation where the county could actually be an importer, where they would collect more than what they actually collect in their local jurisdiction. As we move to the county gas tax options, we're required under NRS 365, 1.192 to have 1 cent per gallon. That comes back to the county in which where the gas is purchased. It's apportioned between the various local governments, cities, counties, based on population. Then you have the up to 9 cents that can support your Regional Transportation Commission. And again, that's a point of origin. There is a statutory provision that says how those revenues will be apportioned. There's also a provision that says, you know what, if the local governments get together, they want to apportion that in a manner that is different than the statute provides. As long as all the local governments are in agreement, you can do that. And in Churchill County, we have an interlocal agreement with the City of Fountain. We split that on a 60-40 basis by agreement. Okay. So those proceeds that go into the RTC funds can be used for construction and building of roads. And since 1997, they allowed it to be used on maintenance or repairs of existing infrastructure. Not all the counties are 9 cents. More and more are moving to that 9 cents. So a summary, very quickly, 11.75 cents per gallon is based on where you buy your gas. 3.6 cents is based on state formula. Okay, so what I like to tell our constituents in our local community, you want your road paved? Buy gas locally, because that does make a difference. It does make a difference where you buy your gas. Gas tax from a pie chart point of view, point of origin, 76.5% goes back to the community in which the gas tax was sold. To help maintain their infrastructure. The summary of the 3.6 cents, 10 of the 17 counties are importers, thus we collect more than what we actually earn on the distribution is larger than what we contribute. And a lot of that reason is it's based on road miles, vehicle miles traveled, and the area. And because some of the rural counties are very large in area, they get a greater proportion of that. There was a hold harmless when they changed the formula in 2003 that froze those levels. So many local governments who are receiving that subsidy, until your revenues exceed what your fixed rate hold harmless amount is, that amount is going to remain the same. We projected that out in Churchill County, and I think we got another 36 years before we'll get an increase in our distribution of the 3.6 cents. So it may be quite a while before we do see an increase. The gallonage per capita is an interesting statistic. And I gently remind people, you can tell where the Interstate 80 and 95 run. You can see the disparity in the amount of gallons per capita. Our friends in Washoe County and Clark County have index. So real quick, again, gas tax is a big portion of intergovernmental revenues. It's an excise tax. That rate is fixed. Gas tax is per gallon. It's not as the price of gas goes up, it's not like sales tax where our revenues necessarily increase. We do have a 1/4 cent sales tax that does support public transit. That's managed by your local regional transportation commission. What you may also do is have a road impact fee if your governing body wants to enact that. In Churchill County, we have a $2,300 road impact fee for a single-family dwelling unit at the permit level. What other revenue resources that are available as it relates to support road infrastructure? The board could, by a vote of the people, you could increase the 1/4 cent sales tax up to 0.5%. And Clark County is the only one that has done that. You could also increase your vehicle registration, your government services tax. You could increase that, but that also would take a vote of the people. And the fuel indexing has provided additional revenue resources to Washoe and Clark County. So, real quick, let's talk about charges for services. Local governments. We have administrative assessments. So what happens there is in the courts, there's a lot of additional fees that are assessed on court cases, on court filings to help support the operations of the court. Foster care programs and different types of programs. The assessors collect a property tax commission. Is assessed on property that goes to support that. You have the court filing fees, the recorder fees, public defender fees. That's something we'll talk very briefly about. Okay, the county is required to provide public defender services for those folks who are indigent and can't afford them. There is no prohibition against assessing a public defender reimbursement fee. You may want to start out at just $25, and by starting and maybe collecting a small fee there, it gives an opportunity to get some of that reimbursement back, as well as force the judge, force the people going through the system to maybe more appropriately define whether that person is actually indigent and needs the services of a public defender, or could they actually afford outside counsel themselves. Return check fees, as people bounce a check, cemetery fees, sheriff fees, and technology fees. Some of these fees, they're charges for services, if you will, the intention is to charge those who are using the service to help defray the cost of those specific services. We look at fines and forfeitures, forfeited bail, fines, delinquent property tax penalties that are collected on those folks who are late paying the property taxes. Fines and forfeitures are a way to collect additional revenue, but also with that obviously comes some potential public scrutiny. We look at some of the miscellaneous revenues. Typically, the largest miscellaneous revenue we see is interest earnings. A lot of folks have money invested in the local government investment pool, LGIP. It's really important as elected officials governing people to make sure that your entity has an investment policy that looks at ways to increase the yields on your investments while maintaining the safety and liquidity. If we sell property, if we have facilities that we lease out space, that's another source of revenues that could be used. Believe it or not, people want to make gifts and donations to a local government. We classify that as miscellaneous revenues. Sometimes through parks and recreation and social services, certain people may want to donate money for a specified purpose, and it would be classified there. Miscellaneous sales and miscellaneous revenues could include, believe it or not, actually, if you enter into an agreement with someone who receives a tax abatement or other revenue enhancements. So that's a real quick whirlwind tour of where the money is. It's really, really important as local officials that we understand where our revenues come from, how they're derived, and what's the stability of that revenue. Because if it's only one-time revenue, we probably don't want to align that with one-time type of expenditures. If it's revenue that's going to be consistent, it can be projected to come in and has growth year over year, such as perhaps the CTAX and the property tax, then that can help us to better build our budgets. So there's a quick summary. Again, thank you, and appreciate. I'll answer questions at the end if anyone may.
Hello, my name is Kathy Lewis, and I'm the clerk treasurer with Douglas County. Thank you, NACO, for inviting me. And it's always hard to follow Alan. He's so knowledgeable about local government and revenues. We'll briefly talk about just the overview of property tax. In retrospective, it talks about, this slide shows the history of the property tax, but probably the most important line is in 2005 when the legislature capped property taxes. They capped it at no more than a 3% growth for residential and no more than an 8% growth for commercial. And that is brought lots of questions, especially when the economy went down and people's taxes kept going up. So we'll look at that too. The rate, and then also too, when the economy decreased, you see the commercial rate is up to 8%, but it's the greater of the 10-year average of the AB in the counties. And then a couple slides later, we'll see that most of the counties, or some of the counties, still have a negative growth rate over these 10 years, or 2 times the CPI, which in, I think the next one, which in 2016-17, that greater of was 0.2%. So if the commercial rate is, commercial cap's only at 0.2%, the legislature put in a trigger that they're not going to let the residential or the residents pay more than the commercial. So then the residential cap went down to 0.2% too. So the residential, your personal property cannot be more than the commercial cap. And I have a slide later on that shows really how this cap has been interesting from the very beginning. I think I started with Douglas County in 2004. Loved testing property taxes at that time. Take the assessed value times the tax rate. I was done in an hour, maybe an hour and a half if I wanted to stretch it. I do try to test property tax bills every year to make sure they're calculating correctly. But I never could have, if people ask me what happens when the economy goes down, or what happens when this, I don't know until you run the numbers. It's so interesting how this cap plays out. And this is really small, but it comes from the Department of Taxation, and it shows what those cap factors are. So you can see in the first column the moving average 10-year growth rate. In some counties is still negative. So when you're looking at the greater of for the commercial rate, that wouldn't apply because it's a negative. So then you go to the CPI change. So for 17-18, the 2 times the CPI change was 2.6%, which meant then that the commercial and the residential cap rate was the same for 17-18, and 16-17 it was the same at 0.2. So not much growth in property taxes in fiscal year 16-17.
Kathy, I know that one is difficult to see, but can you go back on that? Mm-hmm. And I'm from Lander, so I'm looking at Lander, and Lander is 25%.
That average moving rate, so over the 10 years, the assessed value, I would imagine probably, did your assessed values increase quite a bit lately?
I don't think anybody else is in double digits.
So then it brings in that 8% cap. So we wouldn't do a 25% cap on commercial, so then it brings that 8% cap for you. But your assessor would be able to help you look at those numbers, and then the state too, of what makes up that average, rolling average. And these are published on Taxation's website for years back too. This parcel example I took from an actual parcel in Douglas County out in the Johnson Lane area, if you're familiar with it, to look at what happens with taxes. We had a lot of questions. I'm not sure you guys did either. We had a lot of questions when the economy is bad. People would come in and say, my assessed value has gone down. Why are my property taxes still going up? This doesn't make sense. I know you're calculating it wrong. I get that a lot. So if you look in the second column, you see the actual assessed value on this property started in 2005, 2006 at $137,000, went up to $163,000 in 2009, dropped to back to $130,000 in 10, 11, and then it slowly increased. We're back to 15, 16 at $131,000. So if you look at the very second to column to show kind of that that changed. You know, it was a 41% increase, it went to a 13% increase, 5%, and then it dropped 7%, dropped 20%. So that's what residents were seeing is, I'm seeing a 20% drop in assessed value, my taxes are still going up for that. That's because there's still a savings, there's still an abatement to those property owners. So the actual taxes, the gross taxes are what they could have paid if nothing happened in 2005. Over this 10-year period, this parcel would have paid $43,000 in taxes to the local governments. But because the taxes were capped, they actually only paid $31,000. So but you see in that very far column, it was a steady 3% growth throughout all those years. So this taxpayer still over 10 years saved $11,000 in their taxes with the cap. And then I was just going to say, the very top column, the 2006-07 actual change in taxes was a 12% growth. That's because this parcel had new value on that year. And the new value is not capped. There's no abatement on new value for so when it comes on. So when someone builds an addition, that first year there's no abatement. This last slide I put in, and I know I talk very fast, so I'm almost done, but this last slide I put in is if you guys are considering increasing your property tax rate for your local government, what does that mean? What would you get from it? If you increase your property tax rate, there's a couple things you have to be careful of. One is, it's great because you can get the revenue on the new assessed value. So anything new that comes on, you get the full tax rate. If you have a tax rate of 13 cents, effectively, you could be only getting taxes at 10% because there's abatement, but you get the full 13% on new assessed value. Most likely, on all existing assessed value, that increase would just go to abatement and it would slowly increase over time. But you have to make sure that your tax rate does not exceed the tax rate that's allowed by state. So each individual entity has a tax rate that state taxation determines that you can have. And then the overlapping rate for those individuals cannot be more than $3.66. So you can't necessarily increase your tax rate if your rate is in a district that has a 366, already at the 366 cap. I was going to show one more thing before I'm done. I also put on here, if you look on the far right, the two columns that says effective assessed value and effective tax rate. I do show that to taxpayers when they say, you know, what's going on. I say, well, effectively, you're only being taxed at a 2.54% tax rate, even though your assessed tax rate is 2.8. Or, depending on the taxpayer, which one they like to see better, their effective assessed value at the very bottom is $117,000 when their actual assessed value is $131,000. And that's from the benefits for them for the abatement. And that is my information, and I'll pass it on. Thank you.
Thank you. Good morning. My name is Kevin Williams. I'm with the Department of Taxation. I'm a management analyst, and I'm charged with wrangling CTAX. So I'm here today to give you a brief overview of the Consolidated Tax. Consolidated Tax, or CTAX, was formulated in 1997 as a way to combine the distribution of 6 different tax types into one monthly distribution. Each tax type has unique distribution rules and formulas which are applied. Additional details can be found in NRS 360 or by contacting the Department of Taxation. So this is a list of all the buckets that make up our consolidated tax distribution. We have cigarette tax, liquor tax, government services tax, real property transfer tax, basic city county relief tax, and supplemental city county relief tax. Cigarette tax, all revenue from cigarette excise tax is not distributed in consolidated tax, but a portion of it is calculated by taking 5 mils per cigarette or 10 cents per pack of 20. The total amount of tax collected statewide is distributed amongst counties on the basis of their population, and this is per NRS 370.260. Liquor tax, again, a portion of liquor tax collected by the department is distributed in consolidated tax, 50 cents per gallon of liquor containing over 22% of alcohol. The total amount of tax collected statewide is distributed amongst counties on the basis of their population, NRS 369.173. Government services tax, formerly called motor vehicle privilege tax, is collected by the Department of Motor Vehicles. It is based on the value of a motor vehicle at the time of registration. The GST is distributed back to the county of origin. And you can see again, NRS 482.180 and 482.181 cover this. Real property transfer tax, 55 cents per $500 value of real property transfers within each county is distributed in consolidated tax. The RPTT is distributed back to the county of origin, NRS 375. Basic City County Relief Tax, or BCCRT, 0.5% of the 6.85% statewide sales tax or use tax rate is distributed in consolidated tax. The BCCRT is distributed to the county where the sale is made. For out-of-state companies, BCCRT is distributed amongst all counties on a basis of population. Supplemental City County Relief Tax is 1.75% of the statewide 6.85% sales tax. SCCRT is distributed back to the counties based on a statutory distribution formula. This is per NRS 377.057. And the final component of consolidated tax is our supplemental city county relief tax. Eight of the Nevada's counties, or guaranteed counties, receive a guaranteed monthly allocation of SCCRT regardless of their SCCRT receipts per NRS 377.057. The remaining counties, also known as our point of origin counties, they receive the SCCR distribution in proportion to the amount of in-state collections compared to the state as a whole for the guaranteed counties that they've received. We'll see an example of this on the next slide. This might be a little difficult to see, but this just gives a breakdown of how the SCCR is calculated. If you can see, the guaranteed counties distribution is subtracted from the total in-state collections. Here that gives us, in our example, 58.967 million minus the 2.9 million that is allocated to the guaranteed counties. That gives us a total of $5.601 million for SCCR point of origin counties. The percentage of each point of origin county in-state collections to the whole of the remaining in-state collections is then determined. Here, our example takes Clark into consideration, showing that their in-state collections was $44.208 million. So that's divided by the total point of origin SCCR collections, and that gives us a percentage of 77.97%. Then the above percentage is applied to the total amount remaining after guaranteed counties distribution. Here again, we use Clark as our example. We take the Clark percentage of 77.97%, multiply that by the $61.265 million in available distribution, and we get Clark's distribution for SCCRT of $57.772 million. Consolidated tax is calculated on two tiers. Our first tier, the total amount of CTAX collected available for distribution from all the components is allocated amongst the 17 counties. Think of it as 17 buckets, each containing one county's total distribution. Here's an example of our first tier calculation. The consolidated tax components are highlighted in green. There you can see BCCR, SCCR, cigarette, liquor, property, and GST. The total amount here in our example for Carson City Highlighted in orange is the first tier distribution for the county, which you can see in this example is $1.65 million. The second tier calculation is where distribution is further broken down from using our first tier amount, distribution amount. Revenue is now allocated amongst the local governments and special districts in each county according to base and excess distribution formulas. These formulas were revised by Assembly Bill 68 of the 2013 legislative session. Each entity or local government has a base allocation that was determined when CTAX was established in 1997. Base allocations are recalculated annually. Previously, the actual allocation multiplied by the Consumer Price Index determines next year's base allocation, and that was NRS 360.680. But as of July 1st, 2014, our new annual base allocation is determined by calculating our prior year's entire distribution for the prior year times a 5-year average of this Consumer Price Index. Here's an example of our base distribution. Revenue available to distribute is the same as our first tier distribution. In this case, again, Carson City. Their first tier distribution total was $1.65 million. And here you can see again, our revenue available to distribute is $1.65 million. It is allocated among the local governments according to the base distribution percentage. In the case where revenue is less than the base distribution amount, a modified distribution is made prorating the amount of revenue available among the local governments in the same proportion as the base distribution. The excess distribution is the amount of revenue available to distribute after the base distribution has been made. Excess distribution is distributed based on a formula combining the 5-year moving average of the changes in population and assessed valuation for each local government. Special districts have no associated population, so only the change in assessed valuation is used in calculating the excess distribution per NRS 360.69. An example of excess distribution calculation: the revenue available to distribute less the base distribution equals the amount of excess distribution. Here you can see that we had $1.65 million available to distribute to Carson City. Their total base distribution was $1.618 million, giving us excess distribution of $31,000 about. Conditions for using a 1 plus versus 0.02 plus excess distribution formula. All counties, with the exception of Clark and Washoe counties, calculate their excess distribution according to a 1 plus formula, which is 1 plus calculated growth rate, which we talked about previously. Clark and Washoe, however, are the only counties that calculate their excess distribution according to the 0.02 plus formula. And in summary, the CTAX distributions, Consolidated tax distributes 6 different tax types. The first tier calculation is the gross revenue allocated to each of the 17 counties within the state. The second tier calculation allocates the revenue amongst the entities within that county. The base distribution is calculated prior to the excess distribution, and the excess distribution may be distributed using the 1 plus or 0.02 plus formula. That is it. Thank you.
Good morning. My name is Jeff Mitchell. I'm going to talk a little bit about net proceeds of minerals. Currently, I'm the Deputy Director of Local Government Services, and so I oversee both centrally assessed, the calculations on that tax cap that was mentioned earlier. That's me. So I don't know if this is appropriate or not, but I'll throw out my phone number. Give me a call. 684-2095. Anytime, I'm more than willing to talk to you about anything there. Net proceeds of minerals. This was my main area of focus. Well, not my main area, but one of my areas of focus the last 3 years. In general, it's a fairly simple tax to understand. The mines out there, they develop a gross yield. So take a gold mine, for example. They produce 20,000 ounces of gold. They sell it at the spot price for gold. They end up with a bucket of money. From that, they're allowed to take certain deductions for extracting that gold out of the ground. And with those deductions, we come up with the net proceeds. And then there's a tax rate that gets applied against the net proceeds. Net proceeds is considered a property tax. So the tax rate is loosely based on the combined property tax rate. And I'll talk about that loosely there. It's on a sliding scale. So the rate of tax depends on the percentage of ratio of net proceeds to gross yield. Basically, how easy was it for the mine to get that gold out of the ground? If it was a really difficult mine, a lot of processing, a lot of work to refine the gold, obviously their deductions are going to be more, and so their net proceeds ratio is going to be less. They're still making a profit, but it's not. They're not getting $1,800 an ounce per gold at the end of the day. And so if that net proceeds as a percentage of gross yield is less than 10%, the tax rate, the floor, would either be the combined property tax rate of the district that that mine is in, or 2%, sliding up to 5%. There's a couple of exceptions there, and so we'll talk about that. The floor for the net proceeds of minerals is always the combined property tax rate where that mine is located. So even though that sliding scale went down to 2%, if the district that that mine was in, the rate was 2.5%, it's never going to go down to that 2%. It will floor at that 2.5%. That way the county is made whole. Now let's say you have a really productive mine out there in the county where the tax rate is 2.5%. Yeah. If the net proceeds exceeds $4 million, that means they're making a lot of money, or that ratio is higher than a certain percentage.
Guys, he's coming in right now.
Then where does that excess money go above that 2.5%? Let's say they're getting taxed on 5% because they're at that upper tier, that ceiling. That distribution goes back to the state after the state debt. So the county gets an amount equal to the net proceeds multiplied by the combined rate, no matter what. 17 per 100 assessed goes to the state debt, and the balance, if any, goes to the state general fund. So let's take a look at what that kind of looks like here. Oh, I went too fast. I apologize. So that's kind of hard to see, but that's been a general feel and flow of the net proceeds going back. I think that goes back quite a ways here, back to 1996. The red portion is the amount that's going to the state general fund, and the blue portion was the amount that's going to the county. So take 2015, for example. The net proceeds collected from the mine of approximately $101 million. Of that, $51 million went to the counties, and about $50 million of that went to the state general fund. Here's some of the main counties that received money from net proceeds. Out of that $51 million that got dispersed out to the counties, Lander County got the lion's share of that. So the question earlier on the property tax rate, where your growth rate was 25%, net proceeds is your culprit. Because you go back 10 years ago, you probably had a mine that wasn't producing quite as much, and that mine is now gangbusters. And so that growth rate might have increased a lot, and net proceeds plays a major factor into that tax cap on quite a few counties there. So Lander County gets about 32% of that $51 million. Humboldt is a big receiver. Eureka is a big receiver. Nye is a fairly large receiver. Elko is fairly large. Clark, Carson City, Douglas, you guys don't get a lot of the net proceeds. Now something We went back to that first slide where net proceeds is a fairly simple tax to begin with. It got complicated back in 2008. They instituted what was called the prepayment program. Before that, the mines paid taxes in arrear, and it's based on a calendar year. So they would take the gross proceeds for that entire year, they would look back at all their expenses, they would file a return with us in February, we would do a desk review on it, and we would issue, okay, how much tax you owed in April, they would pay that in May, and we'd disperse that out to the counties in June and July there. The prepayment system, instead of payment in arrears, the mines then had to forecast in March and pay in March what they thought the rest of the year was going to look like. And so then we would chew that up approximately about 16 months later in April, that prepayment. When this instituted back in 2008, and I'm going to try to hearken your memories back to that time, 2008 and 9, where gold was per ounce. It was sitting pretty good. During that years, and we'll go back a couple of slides, you can see the spike in the net proceeds. The total tax revenues collected. It really was going quite high, and they prepaid. The drop happened to occur after that March 1st during one of those years. So one of those years, they prepaid based on about $1,700 to $1,800 an ounce. And by the end of the year, gold was sitting at about $1,100 an ounce. And so what that happened with the true up is credits were established. So a mine paid $30 million in March. The next April, we determined that they owed, let's say, $15 million. They now had $15 million on the book. But when that $15 million was established in April and May, they had already prepaid again in March. And so those credits started to expound exponentially. So some mines ended up with $30 or $40 million credit on the book. And that, I understand, can be quite difficult to finance and budget for on counties. How much is out there, where's gold going to go, basically. That got simplified. This last legislative session, I want to give them all hugs and high fives. The prepayment system sunsetted. It resulted in a painful year because they no longer made that prepayment in March of 2017. So the money was kind of offset and working the true up and the prepayment. But no prepayment came up in March, and then we certified and sent out the tax bills in May and April. So there was a gap year. Last year was kind of the gap year where they didn't have to pay in arrears. A lot of the mines, their year before that, they made a really light estimate on what their prepayment would be. So there actually ended up being distributions last year. Even though it was less than expected, it was more than expected for a gap year when we were expecting no money. This is the first year where we're now going to be able to project and give really good estimates because we're going back to the payment in arrears. This April and May is going to be the first time that they're paying on what was actually produced and their net proceeds, and there's no estimate sitting out there. So I'm really happy about that because that's going to make life easier on us all. If you look at the two calendars that we were tracking in the credits, it is simplified quite a bit. This is just a general overview, the changes from the prepayment to the current. That actually happened June 30th, 2016. So the prepayment sunsetted mid-year. Net proceeds are based on a calendar year production. So this was a little difficult to administer, but I believe that we made it through without too much scarring, and things are kind of back the way they should be, in my opinion. So payment on net proceeds is going to be due by May 10th this year, and then that will be dispersed out to the counties, and it'll be fairly simple. When it comes to projections, the mines, so we can work with budget purposes, they still have to file with us March 1st what they believe their production will be for the calendar year. But there's no prepayment associated with that now. So those numbers that they provide in March, that gets communicated to what the Department of Taxation refers to the segregation, and local government finance produces projections out to the counties, which net proceeds is a part of. And so those projections will be tied in to those coming out from local government finance, those budget projections. There's some information out there. If you're curious about your county and kind of the different mines that are out there, it's very transparent, the net proceeds bulletins. We list by mine what their net proceeds was and the distribution to the counties and to the state. It's by industry, geothermal, copper, silver and gold, oil and gas. It is a very good report. It's a little mind-numbing to work through, but it's great information in there. With that, I'm done, if that works.
Boy, you guys are quick. Okay. I just want to announce to everybody that all the PowerPoint presentations we've seen today were emailed to anybody who signed up, and they're also on the NACO website. So that's ndnaco.org. Right? And now let's do questions. One thing Jeff didn't put in there, the reason they did that is because the state was broke at that time too with the net proceeds. All the text I was urging. Anyway, so, questions?
Nancy, this is Lorinda in my county. I have a question.
All right, go ahead, Lorinda.
On the consolidated tax distribution, where they showed the guaranteed counties, how do we get to B1?
You can't go back, but I'll let them answer that.
Yeah, I believe it was when they created the CTAX, it was dictated in the statute. So I don't think there's a way. We'd have to do some research.
No.
Okay. Thank you.
And the way you go from a guaranteed county to a non-guaranteed county is if your actual collections exceed your guaranteed amount by more than 10%, you can go ahead and then if that happens, I believe it's either one, maybe 2 consecutive years, they will flip you to a non-guaranteed county. However, if you want to stay on the guaranteed county because it's a one-time, let's say a solar project or a geothermal plant is being built in your entity, you can petition the Department of Taxation and say, you know what, we do not want to go, we want to stay at a guaranteed county, we don't want to go vacillate with the non-guaranteed. Back in the original legislation, the theory is that the guaranteed counties, the amount was set, back in the tax shift during the fair share battles of 91, 93 session, and then it's been tinkered with a couple of times. Those were base amounts for the rural counties, with the philosophy that the other counties would get 97% of what they generate. And it was a mechanism that was to support one Nevada, where some of the rural counties, a lot of the folks move to, they shop in the urban centers, so they contribute to taxable sales in the urban centers, but they still need to provide a base level of services for the constituents back home in those rural communities. And that guaranteed amount, you talk about if you want taxation, but that has the ability to increase based on the statutory formula that looks at the overall growth of the non-guaranteed counties.
And the 10%.
Yes, Lorinda.
I just wanted to follow-up question, please. Can you tell me where that is in the NRS to read up on that, Alan?
I'm going to defer to my friends at taxation. I think it was included in their PowerPoint presentation.
Yeah.
I believe it's chapter 377.
Thank you.
Yes, and the 10%, actually, yes, NRS 377.057. And the 10% evaluative figure of SCCRT collections is over a 12-month period. So if the county received excess distributions over that period, the department will send out notice to the county saying that they're being considered for removal from the guaranteed status. If they want to stay on, just let us know, and we'll put you on for the agenda for the next Nevada Tax Commission meeting, and you can stay on.
Thank you.
Okay, I'll ask you a question. One thing that came up in Esmeralda County is that we looked at our projection for our property taxes and we really felt it was way too high, and a lot of that had to do with the projected work in progress. So maybe someone could talk briefly about how those numbers are, how you come about those numbers, especially with counties that have no building permits or partial building permits.
I'll touch on that. Every January 31st, the county assessor is supposed to submit to the Department of Taxation what's called a segregation report. And the segregation report is basically a list of assessed values per district within your county. And then they have to submit that again by March 1st or March 5th. I'm going to get my dates mixed up there. I believe it's March 5th on the segregation report. And one of the main components of that is what taxation refers to as Ma and Pa. And Ma and Pa is part of the segregation report, and it's a projection based on permits that are out there, both of the unsecured roll and the secured roll. And other components that play a factor in that is also, if centrally assessed, the valuation of utilities, NV Energy, airlines, Union Pacific, various things along that. The Department of Taxation handles the valuation of those companies. They bill and collect, and then they disperse that out to the counties. So there would be no way for the county assessor to track the assessed value for that segregation report. So that portion is projected by the person who handles centrally assessed, and they also project out the net proceeds of minerals. So there's about 3 or 4 different things that kind of come into play with that segregation report. And then the Department of Taxation projects how much property tax revenue is going to be generated off of that. And they then disperse that out to the county. And so the projections, not the actual money. And so each year we send out those projections, and the county officers need to review that because they're the ones with the boots on the ground and have a real feel for what's going on. Sometimes we don't know if there's a solar project that's not centrally assessed that's being built in your county. And so you might have projected, okay, this next year we're going to have a huge increase in that property tax revenue. If that's not included in the report, then that's not going to be included in the projections, and your budget's going to be based off of that projections. So it's important to open up that chain of communication between the department during this projection period, because your budgets are based upon those. I don't know, did that answer a little bit?
It did, Jeff. No, that's something probably none of these folks really realize, so I appreciate that, because we did run into that, and we made the option in Esmeralda County to reduce the amount we used in our budget because we felt that the projection we received was too high. So that I really appreciate you going into that, Jeff.
You know, along those same lines, I think something that's really important from a person who, finance guy in a county that puts budgets together. If you look at the Department of Taxation provides budget estimates in February, the preliminary estimates on February 15th, and then they issue their final projections on March 15th. And there's that one sentence that you see in there is that, if, as Jeff said, you're closer to your entity. Please review, these are for guidance only. It's up to you to determine what the appropriate amount is, based on your own county's situation. And I know in Churchill, especially when it comes to property taxes, I work with my assessor and the treasurer, and we run an independent calculation separate from the pro forma that the taxation uses, because I want to be very conservative in how we project those revenues, because it's a lot. I'm in a better scenario if the actual collections exceed what was budgeted. But sometimes if you just take the final budget estimates that come out on March 15th from the departments and you plug those numbers in, and on some of those estimates, whether it be gas tax, the consolidated tax, some of those they use one size fits all, 4% overall increase, hypothetically speaking, okay? Well, if your entity is not, if there's a decline in population, your economic conditions are such that you're not going to see that level of increase, that. Don't use their estimates. Work with your local government analyst at the department. Over the years I've had various ones, and Heidi Rose, we would have good discussion. As a matter of fact, as they work to develop those estimates, they call up and then say, hey, Alan, what's happening in Churchill County? So work with your friends at the Department of Taxation, the Local Government Finance Division, the people in Jeff's division. They're great people to work with. If you have questions, if you have a question on the consolidated tax, contact the analysts at the department, and they'll feel free to talk to you about that and get a better understanding of what your question is. They'll answer that. And they'll even ask you questions about your local economy that may help them in making better projections.
Steve Taylor from Douglas County. Why March 15th? Why not earlier? Because what we get faced with, most of us are deep into the budget process. Property taxes usually, as you showed in your slides, the biggest revenue source for the counties. You're talking March 15th. We're almost finalizing our budget when we really don't know what that big number that the state's going to give you. Now, we can guess, most people guess pretty conservatively, but why March 15th? Why not those final numbers come in February?
Go ahead, Jeff.
I'll speak to that. The statutory reports that are due to the department actually don't get received by the department until March 5th. And so 10 days, if it was all hands on deck and we recruited everybody in the state, we might be able to turn around March 6th.
So has there ever been an appetite to move your numbers up to, if you move that whole scale up, we could get our numbers faster?
You could. It would require a change in a lot of different things. The unsecured roll, April 20th, is the main deadline on that one for billing, so you would have to move that date up. And a lot of the collections and other things, dates would just have to, and that's not something I have any authority to do. That would be a legislative change.
And the pro forma property tax actually comes out March 20-something, I forget where a penny, because it takes additional time to run that as it relates to the abatements, and that's super critical to do that. So one of the things a comment that I may make is your tentative budget is due on April 15th. The final budgets are due by the end of May. And I know many local governments like to have the tentative budget as close to the final as possible. But that gives you another bite of the apple after you do the tentative to go back. Let's say if you did your preliminary estimates and you already did that prior to getting the March 15th data, you can go back, you receive the March 15th data, you review it, you compare that to your estimates, you work within your staff, within the Department of Taxation, see if that's reasonable. If you need to make that adjustment, you can do that in the final budget. When you do that adjustment from your tentative to the final, you would need to explain that within your budget narrative documents, both at the public hearing, at the tax rate hearing, as well as in the document that you provide the Department of Taxation. But I think you bring up a great point, is timing of estimates. And one of the issues is, I think the key word is it's budget and it's estimated. If we move it up too soon, we don't have enough more current data that the department's able to use, and then their estimate isn't as strong as what it may be. So.
Oh boy, I got a hand back there. Yes, sir.
This one's for Kevin. Can you explain the impact on the CTAX when you have a new city come in and get incorporated?
Well, essentially, your entire bucket gets reduced, right? If the city gets a distribution, but the city has to qualify for certain CTAX distributions before they're even able to be included on our list. So essentially, if they're approved and we add them to our distribution list, based on the services that they provide their constituents, you'll see your entire bucket go down.
And on both Tier 2 and Tier 1?
Yes. Because essentially, whatever county that new local government is, they're sharing that bucket of distributions from your Tier 1 calculation amongst the local entities.
Thanks.
You can ask Kathy about that. She lives in Douglas County that has more special assessment districts than any other county in the state.
Hi, I've got a question that was emailed in from Elko County, who was on the line. The guaranteed counties, you indicated there was 8, but the sample in the slide showed 9. It is 8, right?
I'm sorry, yes, Story is no longer a guaranteed county. I forgot to update that. So it is in fact 8.
So for example, for many years, Story County wrote a letter to the tax commission saying, please do not make us a guaranteed county. And then once Trick took off, they said, let's go. And, you know, they live and die by the non-guaranteed status. And, you know, when they issue their monthly statistical information on the distribution, if you want to watch something that flies all over the place, look at Story County's because of the activity that takes place at the industrial park.
I apologize for not pointing it out, but it was an example from our fiscal year 13-14 distribution, just an example of how the process worked, not to represent what we're actually distributing at current levels.
We got a hand right here.
So I have a question about the fueling stations that are on Indian land and if we get tax from that.
Okay, so if you have a tribal gas station that is on tribal land, what they do is they are allowed to assess whatever tax rate, because that's a sovereign nation, you know, like another state, if you will, or another country. However, they do assess in the state of Nevada the gas tax, and tribal members have a tribal card. So what they do is that when they buy theirs, you know, just like I have a Maverick card and I swipe my Maverick card and I get a discount, you know, on the price of fuel because I use my Maverick card, they swipe their tribal card and they get exempt from paying those taxes. Now, I'm not a tribal member. If I were to buy gas at a tribal gas station, you know, I input my, you know, my credit card, debit card, whatever. I buy gas. They are collecting that gas tax from me as a non-tribal member. Okay, so what happens is that the tribe folks, they actually get a refund. They get a refund, you know, at the end of the month or after a period of time. They do an amended return. So what I have done in Churchill County, because we do have a tribal gas station, is that we have tracked the amount of tribal refunds and the gas tax, and those taxes are paid at the distributor level. So when the trucking company that delivers the gas to the tribe, the taxes are collected at that point, and the tribal submits to, I believe it's DMV, to get reimbursed for those tribal sales to their members, and they get a, if you will, a dividend check or a refund check of tribal sales. But if non-tribal members do pay tax, and those taxes do get remitted back to the local governments by the same statutory provisions of any other gas station across the street that is not on tribal lands. Great question.
I'm going to take Jamie next, but I just wanted to add something to what Alan said. For those of you who do not have a lot of gas stations in your counties, one thing you should bear in mind when you're doing your regulations is to allow backyard gas tags, okay? Because you will get the gas tax on stuff delivered in your county, even if it's not through a gas station. Dagny stated.
I can go last if anyone has any.
Well, I don't see anybody else. Oh, yes.
I've got another question. This one kind of was the topic brought up with Lander County. So they got the net proceeds on mines, right? And in mining counties, you got that boom and bust economy. So are mining counties always going to be lagging behind the economy? So when our economy goes down, they're going to be taxed still at a higher rate and then finally start coming in and following that curve? Or how does that work?
That plays into the property tax calculation, and there's 10 years that come into play there. And so if a mining county had 5 or 6 years, rough years, where that net proceeds was showing a steadily decline, that would be reflected within that property tax cap. Mining has been pretty stable for about 4 years, so a lot of those high years are going to start rolling off that back end a year of that calculation. And so that 25%, that can drop quite dramatically just within 1 or 2 years. And you could be seeing a regular 8% growth rate or a 5%,
or things along that lines. I don't have the spreadsheet with me, but we do have a breakout of a year-over-year growth rate for each county that I'd be more than happy to share, and it's published on our website there. And that is something to take a close look at, because there's some years, as you mentioned, mining county can be boom or bust, where they can even have a 45% growth rate just in 1 year. And that 45% would remain for 10 years of that calculation. On the other hand, they can also have a 35% decrease in 1 year, and that could play into play for a long time. I know that has affected a lot of counties where they had sharp decreases back when the Great Recession hit, and those negative percentages have weighed on that property tax cap calculation. And so even though there's been seeing 5, 6, 7% growth over the last 3 or 4 years, they still have a big negative 12% that's weighing that down. And that's why that CPI has come into play the last couple of years, because there's been negative years that have been weighing down that 10-year calculation.
You know, I think the point you bring up also brings up the issue of fiscal policy, and what I've seen in local governments, more and more local governments are setting up what we call that stabilization of operations fund, the rainy day fund, where statutorily in NRS 354 you're allowed to create this fund, put up to 10% of your general fund total expenditures within that as a safe haven, and go ahead, fund that, use that, because those revenue resources may not be reliable, as Jeff is talking about, from year to year to year. And a lot of the mining counties also will do what they call pay-as-you-go. They will take, during those good economic times, they'll put that money aside. That's when we'll do those one-time capital improvements and those types of things, where they take the advantage of those additional revenues. But to build a budget based on the glory days and the very high source of revenues, knowing that if the economy turns, you can have significant negative impacts, is very, very dangerous. So building up those reserves are really important. There's basically 3 of them that are protected from collective bargaining: the rainy day fund, the stabilization, which is a stabilization fund. You're allowed to put money in a building reserve fund or capital projects fund, and then the third one is what they call extraordinary repairs and maintenance of capital facilities, and you can put money into that as well. So that way, if the HVAC system goes out in a building or a roof needs to be repaired, you'll have money in there to go ahead and do that. And take these extraordinary one-time type revenues, or during the good time revenues, put those into those 3 funds so that you can use those later. That's a really good fiscal policy for local governments to consider.
So I'd like to go back to gas tax real quick. We talked about gas tax, but what we didn't talk about was diesel tax. So diesel tax is taxed at the state level, but not the county level? So
I'm not the total expert on this. Dagny could probably, I'd like her to chime in, but currently now, for those counties that do not have indexing,
correct.
So everyone except Washington and Clark, local counties do not get any apportionment, as I understand, of diesel tax. I don't believe that's changed.
That hasn't changed, Alan.
Yeah, so.
Yeah, there was a bill proposed last session to enable counties to enact a diesel tax, but it didn't pass.
Well, because it was part of the indexing though, right?
There was then a ballot question previous in interim, so before the last session, so in 2016, that asked each county individually whether they wanted to add fuel indexing on, and it passed in Clark County. Washoe already had it, and it did not pass in the rurals.
But I guess my question is, I just don't get, so the state collects diesel tax as a whole, correct? Yes. But is any of that diesel tax that's collected passed down to the counties the same way that gas tax is?
And the direct answer is no. NDOT, if they were here, they would say indirectly it does, because NDOT does projects within the 17 counties using state funds for those projects. I think that the big challenge, as I talked to my Board of County Commissioners, is the problem with gas tax is that people are getting more energy efficient cars, we're moving to hybrids and all of this. And so our collections are going down, but our infrastructure needs continue. And finding ways to finance and maintain the infrastructure at an adequate level is becoming increasingly more challenging for the local governments. In the last 18 years in Churchill County, that's the easiest number for me to budget. You know, they're going to get $2 million of all the different gas tax related revenues is $2 million. It was at, 2000, and it's going to be $2 million in 2019, plus or minus maybe 100,000. So you're not seeing huge increases or decreases in revenue, but the cost of projects continue to go up. Definitely a challenge.
Just for the record, that's not the first time a bill's been tried for the counties to be able to do a tax on diesel fuel. Betsy.
Yes, thank you, Pat Waite, Lander County. It was for Alan. You're talking about the different funds that we can prepare for here, the stabilization fund and rainy day such. Wasn't there one of those that was actually mandatory in the legislature?
No. All of them are optional. I mean, you can go ahead and do those. I don't believe any of them were required or mandated. And those folks who had the rainy day funds when the Great Recession hit, they were able to tap into those funds. And those who have set up those funds and slowly put money aside have been able to take care of needed things for their community.
Something was just in the back of my mind about something in preparation that was mandatory, and I don't know whether it was specifically like water and sewer or something or what, but something was there, and I thought.
Well, there was some provisions many sessions ago. If you go out and you bond and you build a new building and you use bonds, they were required school districts to put a portion of the bond proceeds into the extraordinary repairs and maintenance fund, because what had happened back in the boom in the early 2000s, mid 2000s, Clark County School District had bond money. They could build schools, but they couldn't repair the leaky roof. So, because obviously it was different.
Okay, thank you.
Yes, sir.
I still have time, so I asked Kathy this yesterday, and so it should be no surprise to her. But one of the things that we don't talk about, but we always see on our tax bill, is school tax and school debt. And to try and, I'd like sometimes later is to try and get an explanation on how that whole works, because it's a large portion. It's 1/3 of my tax bill goes to schools. So to try to figure out how that all comes from the county, goes to the state, comes back to the county, and I know they're their own separate jurisdiction, but I get asked a lot because people see that on their tax bill, but I can't really explain how that school tax is either calculated or distributed. And I do know about the distributed school account, but I can't put that together. So, and I don't expect you to, unless you know, to figure that out.
Steve and I did talk about this yesterday. I know in Douglas it's 75 cents. Is it 75 cents in every county?
It is. 75 cents is required by every county.
So it's whatever, that's calculated on property taxes, but then that's collected and given to the school district directly. I did ask the school district a couple months ago, and they tried to explain that the state determines how much they need in total, so then whatever they don't get in property tax, they get from the distributed school fund, but it has to be way more complicated than that, so I don't know.
So oversimplified the way it's explained to me, and actually, one time I had to explain it to the School Board Association, and they couldn't find a tax guy at the school district going to do it, so I was a sucker for punishment, and I met with them. And so they have the DSA account, the distributed school account. Basically oversimplified, they end up through the formula with a per pupil cost. So every school district in the great state of Nevada make up a number. This is not the right number, but let's just say $9,000 per kid that goes to that district. So they take their enrollment times 9,000. That's what the school district gets. So how do they get money into the DSA account? 75 cents of property tax rate is assessed by all the counties, all 17 counties, equal taxation as it relates to property tax.
And that's statutory, correct?
That is statutory. Yeah, so then what happened is that's what we call the operating rate. The debt service rate varies widely, huge, from 0 to over 50 cents in certain jurisdictions. It's 55 cents. It actually got lowered, I believe, to 50 cents in Churchill County. That's voter approved. So when you have school bond issues that go to the voters and they approve it, or rollover bond issues, that adds to that debt service rate. That is different from the other entities. The other large component that helps support the DSA account is the LSST, the Local School Support Tax. That's an element of the sales tax. Today we talked about the consolidated tax, and two of those elements, the BCCRT and the SCCRT, that goes into the CTAX. The local school support tax, that is a sales tax component that is universal to all 17 counties, and that money is collected, and that helps support the DSA account. But you're exactly right, on property tax apportionment, and it's universal in all 17 counties, the largest piece of that pie, of that apportionment, goes to support education. So.
Yeah, I just did want to take a moment to introduce myself for anyone I haven't met yet. Dagny Stapleton, Executive Director of NACO. And I wanted to personally thank everybody for coming, those here and on the phone. And I wanted to ask this group, there was a lot of information today, went through a lot of different things. There's obviously a lot of interest, so wanted to get feedback. I think we've got a minute or two from you guys in terms of would more detailed information on any of these topics be helpful to you? So any of these elements of county revenues that we went through today, CTAX, property tax, would a workshop like this in more detail on one of those elements be helpful?
Can I add something, Dagny? Part of what she's getting at here too is, would you find it helpful to expand on, for instance, abatements, how those work in property taxes, or what you can do as a local entity to assess especially what you can add to your property tax for special projects? And Alan knows about this because Churchill has it. But to get into some of those things, too.
So my question would be is to take what you guys have done today and put it into one statewide kind of pull it all together into like a 1-hour presentation. Because I can tell you, I get it. I don't get it great, but I get it. Most taxpayers don't get it. And what I'd like to see is that like this put into a 1-hour presentation where someone, I'm not saying Alan's going to do it, but someone needs to go or should go to every jurisdiction at a county commission meeting and explain this. Because most people don't get it. And what happens is that county clerks get it, assessors get it, they all get questions. And if they happen to own property in 2 different jurisdictions, whether that be a GID or 2 different counties, they get different answers because the taxing structure is different in each jurisdiction. So, I mean, I would just like a generality, whether it's NACO or anybody else, come in and say, we're going to give a presentation at a Board of County Commission meeting, and let's talk taxes, or what you guys called it, where's the money? Because most people, I can tell you, even today, one of my colleagues thinks that he can grab school money. Well, they don't get that that's statutory, and I carry my tax bill around on my phone because I'm constantly referring to it, is that there are things that we county commissioners have no say over, and people don't, and yet they're the biggest revenue source for us as a county entity, whether you're schools or non-schools. And I just think that, what we've learned today, but we're preaching to the choir here. And I think the people that really need to hear it are the taxpayers.
Right, and then tie into that too, what those revenues can and cannot be used for. Yeah. Because it's more than just the schools, right?
Correct.
And that's where a lot of residents are confused or get angry, thinking that they can just tap into any of it.
So the request would be a presentation put together by somebody, maybe NACO could figure out a way to coordinate something like that then could be taken on the road, and each commission could request a presentation be given to their board and the public?
That's just me from Douglas County. I don't know about the rest of the counties, whether they think that would be valuable to their constituents.
I think there's some resources out there. The Nevada Taxpayers Association puts out a booklet, Understanding Nevada Property Taxes, Understanding Net Proceeds of Minerals. The Department of Taxation, as they reference on their website, they have excellent information that explains different things. Those are good resources, but I think having presentations in public forums are important to help.
Yeah, general overview with the information of where to find more detailed information so that the residents can go after that, and I think would be good.
Because a lot of them, all they see is that end balance you have in there. Why can't you fix the roads? You have all that money there. They don't get that you have to keep so much of that money there.
Yes.
playing on your idea about going out to the different counties, which is an excellent idea. At the same time, your constituents aren't able to always attend your county commissioner meetings. Might be a good idea if this does take off and you go to all 17 counties, you find out what the common questions are, and you make a video at the end, and then that way your constituents can access the video anytime on their time and get the answers that they're looking for.
Just so everyone knows also, we're on a video conference system right now, and if everything goes as planned, we will have a recording of this, and that will be on the NACO website. So there should be a video of this workshop available, and you could send that link out, to residents or use it at your county. So reach back out to us if you're interested, and we'll let you know if all went well and if that's something that we have that you can share. Okay, thanks everybody, and I'll turn it back over to Nancy, but I also just wanted to thank the Emeritus Committee. They help us out a whole lot, our termed out former commissioners. We appreciate them.
Well, I have nothing left to say. NACO and all of our speakers.
Great. So if you do want another one on more detail, we'd like to have you here, and she can arrange it maybe next year or sometime later in the year. Thank you all again. Drive safe.
The extended studies at UNR also has classes that go in a little bit more detail.
It's nice to see you.